Welcome back. Today's lesson is the sixth and final lesson in AP Macroeconomics Unit 2, which is our Economic Indicators unit. So up until this point, we spent a whole bunch of videos talking about GDP and the calculation of real GDP. Our last video ran through the second economic indicator, which is unemployment, and we're going to wrap up this unit with a discussion of the inflation rate. Hopefully this is going to be a relatively brief run-through on inflation. I don't think it's anything the kids have too much difficulty with. They have some familiarity with inflation. So big question number one that we're going to run through is basically just running through some definitions that the students will need to know. So we're going to start off with the big question, what is inflation, and kind of what are the different flavors of inflation that we're going to be talking about in this unit. So students are familiar with inflation. Inflation is the steady increase in the overall price level that occurs in almost all market economies over time. Students will often want to know, why is it that prices pretty much always go up and never go down? That's beyond the scope of this course. Even economists with PhDs disagree on the exact mechanisms that cause steady and consistent inflation. So what they need to know is that prices in market economies generally increase over time, and provided that increase is slow and steady, we're going to refer to this as inflation. So the Fed is primarily responsible for controlling inflation rates in the United States, and so we're going to consider a safe level of inflation to be anywhere between about 2 and 4% inflation in the economy. We tend to get a little bit stressed out when the inflation rate is too low, as that's a sign that the economy is not growing and you're not seeing demand pull inflation. And we also tend to stress out when the inflation rate gets substantially above about 4%, because that's higher than we like. So kind of the sweet spot for inflation in the United States, we tend to aim for somewhere between 2 and 4%. The second term that the students need to know is hyperinflation. So hyperinflation is exactly what it sounds like. It's just inflation that's kind of gone too far. So rather than a slow and steady increase in the price level over time, hyperinflation is a rapid increase in the price level over a relatively short period of time. So if you're seeing, inflation of 12 or 15% per year, or heaven forbid you end up in a situation like Venezuela or Zimbabwe did, where you're getting 8 million% inflation in a year, this is what was no longer inflation. We've gone past that. We are now in the realm of hyperinflation, and we definitely don't want to see that. The third major term students are somewhat familiar with is the term deflation. We're going to define deflation as basically a negative inflation rate, meaning that there's a steady decrease in the overall price level over time. Students tend to have some difficulty with deflation because they tend to think of inflation that's going down as deflation. You'll want to stress to them that unless the inflation rate is actually negative, we can't call it deflation. So unless prices are actively falling, we're not going to call this deflation. The Fed tends to really stress out with the prospect of deflation, because generally the only times an economy will experience deflation, at least a market economy, is in the depths of a really, really bad depression. So if there's so little demand for goods and services that just basically nobody's buying, you might start to see deflation and prices come down as sellers attempt to compete to get rid of their stock. So while deflation might sound like a good thing, students are like, oh, things are getting cheaper, that's great, I can buy more stuff. It's actually a really, really bad sign. Economies will only experience deflation when something relatively disastrous has occurred. So you'll want to stress that to them. I like to tell them the famous quote, I believe it was Alan Greenspan, said he wasn't really worried about deflation because if the economy experiences deflation, he'll just throw money out of helicopters until the deflation goes away. I thought that was somewhat humorous. You may or may not want to share that with your students. Last but potentially most confusingly, we have this fourth term that for some reason students have had difficulty with over the years, and that's the term disinflation. Students tend to have a difficulty differentiating between disinflation and deflation. So disinflation is a reduction in the overall level of inflation, but that there is still inflation. So for example, if we're going to go from a 10% inflation rate, which is too high, it's going to stress us out, and we manage to drop our inflation rate all the way down to 3%, this is not deflation because there's still 3% inflation. Our inflation rate is still positive. This is disinflation, which for some reason students have some difficulty with that. So you'll want to stress disinflation means there is still some inflation. There's just less inflation than there was before. The next big question we're going to answer is, how do you calculate the inflation rate? This is relatively simple and should be a review of something that we went over earlier in the unit. So for reference, the inflation rate as a percentage is equal to the consumer price index of year 2 minus the consumer price index of year 1 divided by the consumer price index of year 1 times 100, which in this case, year 2 is pretty much always going to be our later year, and year 1 is going to be our earlier year. So I believe in our example, we were attempting to compare the prices in 1940 to the prices in 2019. So in that example, 2019 would be year 2, CPI 2, and 1940 would be CPI 1. Once students can do that math, and I found they're pretty capable of doing that, we're going to move on to kind of the big question, which is, why do we care about inflation? So it's one of the big 3 economic indicators that we care about in this course, and so we need to go over specifically why it is that inflation matters, beyond kind of the obvious students don't want prices to go up. So the first big reason that we care about inflation on a macroeconomic sense is that inflation has costs, and these are going to include shoe leather costs, menu costs, unit of account costs, etc. So basically what this means generally is that inflation causes inefficiencies in the macroeconomy. So sellers are going to incur shoe leather, menu, and unit of account costs. They're going to push those additional costs onto their consumers, so consumers are going to have even higher prices. And just across the board, this isn't good for the economy, right? We don't want to see really, really high inflation or these types of things get out of control. More importantly for the advanced placement macroeconomics course is reason B that we care about inflation, which says inflation has an indirect impact on real GDP. And this is the one you're going to want to spend some time on with the students. So students need to understand these relationships and how all of these different indicators are going to relate to each other, because it's something that's going to be tested fairly heavily when we get to the aggregate supply, aggregate demand unit that we're going to be moving on to relatively shortly. So, long story short, the reason why inflation rates impact real gross domestic product is because inflation rates are a component of nominal interest rates. So the interest rate that students will pay when they borrow money, or businesses, more importantly, will pay when they borrow to invest, are partially dependent on the rate of inflation, or what's called the anticipated rate of inflation. So the interest rate that you actually pay at the bank when you borrow money is basically the sum of 2 different things: the anticipated rate of inflation, which is what we care about here, and also the real interest rate, which is essentially the amount of profit that the lender looks to accrue as payment for the time value of their money. And so because inflation is one of the components of nominal interest rates, higher rates of inflation lead to higher levels of nominal interest rates. And this isn't good for borrowers at all. And you might think that it's good for lenders, but it's actually not particularly good for lenders either, as any profits they would get from those higher interest rates are just going to get eaten up by higher prices caused by the inflation. Now, these higher interest rates have an impact on the macroeconomy because nominal interest rates and the level of investment spending in the economy have an inverse relationship to each other. So businesses, by and large, don't hold on to large amounts of cash reserves. Even very profitable businesses don't usually hold on to millions or billions of dollars in cash because that money is better put, invested, or they're spending it somewhere else. So when businesses tend to spend money to invest, more often than not, that money is going to be borrowed. So the interest rate on the credit markets actually impacts businesses' willingness to invest. Businesses, just like consumers, would rather pay lower interest rates than higher interest rates. And so when we see the nominal interest rate rise, in this case because of high levels of inflation, the end result of that is that we're going to have reductions in the overall level of gross private domestic investment in our economy. Businesses will see those high interest rates, decide that it's harder to turn a profit on their investment, and they'll just decide to either not invest at all or to wait until interest rates are lower to borrow the money and invest. And so because gross private domestic investment is one of the components of GDP, any increase in nominal interest rates will result in lower investment spending and thus lower levels of GDP. So one of the impacts of higher levels of inflation is lower levels of productivity in the economy, which is going to show up as lower real GDP numbers. Do note briefly that this relationship that I'm discussing here is only true for real GDP, as if we're talking about nominal GDP will actually rise as prices of goods and services rise. So make sure that we're differentiating between nominal GDP and real GDP here to prevent confusing the students. So the next big question I want to address briefly is who is helped and who is hurt by unanticipated inflation. The word unanticipated is underlined here because the impacts of inflation that we don't see coming, aka unanticipated inflation, are different on the economy from the impact of inflation that we already have seen coming and that we've already made adjustments for. So if I'm a bank or I'm a lender and I predict that there's going to be high inflation next year, I'm going to start adjusting my interest rates based on that future expectation today. Whereas if inflation spikes and I didn't see it coming, I may end up being harmed by that unanticipated inflation. But although lenders might be harmed by it, there are some people who benefit from high levels of unanticipated inflation as well. So let's go over the whole list, who is helped and who is hurt by unanticipated inflation. So the biggest group of people that are going to benefit from unanticipated inflation, and this includes almost everybody, are going to be your borrowers or your debtors. And we're going to presume for the purposes of this that these borrowers are borrowing money on fixed rate loans. So for example, a mortgage, a normal mortgage anyway, is going to be on a fixed rate loan. You're going to agree today to pay a certain percentage every single year for the next 30 years. Well, if sometime within the next 30 years we hit large levels of unanticipated inflation, all of a sudden inflation rates spike up to 12 or 15%, and we didn't see that coming, it's actually going to make it easier for borrowers to be able to pay off their debts because as that inflation increases, borrowers are going to end up paying back dollars that are worth less or have less buying power than the dollars they initially borrowed. So if I'm a borrower and I owe a whole bunch of money, which some of our students are about to become, unanticipated inflation actually beneficial to me because it helps me to pay off my debts with dollars that are worth less than the dollars that I borrowed. Lots of groups of people are harmed by unanticipated inflation, lenders being the most obvious ones. So banks and financial institutions pay economists a lot of money to create models to predict how much inflation is going to happen over long periods of time. And one of the reasons they're willing to do that is because unanticipated inflation can have a major, major impact on banks and financial institutions' ability to be profitable. So because inflation eats into their profits, they need to make sure that the interest rates that they're charging on their loans are higher than the rate of inflation. Otherwise, they end up not actually making any real money, or the real interest rate would either be zero or, in really bad circumstances, negative. So if I'm a lender out there, I need to make sure that I'm charging consumers a higher interest rate than the rate of inflation, or I won't turn a profit on this, and that would be really bad, especially if I didn't see this inflation coming. Another group that are very much harmed by unanticipated inflation are your savers. So anybody who has a large life savings or a trust, unanticipated inflation basically goes in and lowers the buying power of the dollars that they have saved up. This can be really detrimental when you get to hyperinflation. So for example, if you were a saver or a retiree in Venezuela recently, you saw the buying power of your life savings basically evaporate into nothing as the currency experienced hyperinflation. So it's very, very bad for savers. High unanticipated inflation is also really bad for anybody on a fixed income. This is primarily going to be your retirees and your pensioners. So if I have a set retirement plan that always gives me, I don't know, $500 a month as a payout, as prices go up, what I'm able to get in return for that $500 decreases over time. And so if you're on a fixed income and your income doesn't change along with price level, unanticipated inflation is really bad for you as well because it slowly but surely erodes your buying power. Last, I want to talk about one group of people who are neither helped nor hurt by inflation, and that's anybody who's on a flexible income. So if you receive what's called a cost of living adjustment, or a COLA, then unanticipated inflation doesn't really impact you one way or the other. So a COLA is what we call it when businesses will automatically increase employees' wages based on the inflation rate of the previous year. This isn't considered to be a raise because you're not actually having an increase in your buying power, but it's a COLA. They're going to come in, they'll be like, there was 2% inflation last year. I am automatically going to raise your wages 2% to keep your buying power this year in line with where it was last year. If you have a flexible income and if your income automatically adjusts for inflation, then inflation doesn't really hurt or help you, provided that you're not in one of the other camps of people that are helped or hurt here. This is a good time to talk about the minimum wage, because the minimum wage notoriously does not keep up with inflation. And so we may raise the minimum wage once every decade, or sometimes not even that. And so workers who are on fixed incomes, like minimum wage workers, are hurt, whereas workers who aren't earning minimum wage and are getting cost of living adjustments aren't hurt by unanticipated inflation. You could turn this into a sales pitch for picking a good major in college, so you can get those good jobs that will automatically adjust for the rate of inflation. Last but not least, I like to go over the different types of inflation. So this isn't going to fully answer the question, why is there inflation, but at least going to help the students to differentiate a couple of the different causes that are going to cause inflation in our economy. So the big two that they need to know for the purpose of this class are what are called demand pull inflation and cost push inflation, which is sometimes referred to as stagflation. And they'll be seeing that term in the aggregate supply aggregate demand unit in the next unit. Demand pull inflation, I like to describe it as too many dollars chasing too few goods. So demand pull inflation is inflation that occurs when the economy is doing well and we're in economic recovery. As the economy does well, we start to see the unemployment rate fall. People are they're working and they're getting paid more for their work because there's competition within the job market. And all these people who have jobs and they're earning higher incomes than they used to, what do they want to do with that additional money? They want to go out and spend it, right? So they all show up to the store looking to buy goods and services, roughly the same goods and services, and there aren't enough goods and services to go around, so stores, sensing an opportunity, will start to raise their prices, right? And so you've got all of these workers with all this newfound wealth coming from good economic conditions, and one of the things that's going to be caused by those good economic conditions are going to be higher prices, as all of these consumers all of a sudden come into competition with each other for the same basket of goods and services. And so you can use all sorts of examples. I'm kind of old, so my default example of this used to be the Tickle Me Elmo doll and prices on eBay where people were paying $500 for Tickle Me Elmo in the 90s. I think we've probably gotten to the point where students don't remember Tickle Me Elmo, but you can come up with any other example where the demand for a good far exceeds the supply of it, and it drives up prices. I think most recently the example I used was demand for certain Yeezys. So when Adidas came up with Kanye West's shoe, the Yeezy, some of them were in particularly high demand, and if you got them, you could resell them on the secondary market for, $1,000 or $2,000 for a shoe that only costs $200 retail. Depending on who your kids are, you can tailor your example of demand pull inflation to whatever they're interested in. There's lots of examples out there. Basically, too many people looking for goods and services, not enough goods and services to go around. Result is prices on goods and services go up, aka demand pull inflation. Last but not least, we have cost push inflation, or sometimes what's referred to as stagflation. This is fundamentally different, although it's still inflation, so prices are still going up. The reason why is fundamentally different compared to demand pull inflation. Cost push inflation is not part of the normal business cycle. So when the business cycle goes into recovery, we just naturally see demand pull inflation. Cost push inflation is inflation coming from outside means. Specifically, when our economy experiences cost push inflation, this is usually a rise in the aggregate price level coming from increases in production costs. Most of the time, those increases in production costs are coming as the result of shortages in inputs that are driving up input prices or commodity prices. So our classic example of this would be the Iranian oil crisis that happened in the 1970s. We had oil shortages, we had rationing of gasoline, gas prices went through the roof. Because petroleum products are an input into thousands and thousands of products across the macroeconomy, you started to see the price of goods and services rise due to higher oil prices. So when there's shortages in our inputs for either artificially or natural shortages, prices of those inputs are going to go up, and this is going to cause stagflation. And this stagflation is resulting in from a reduction in overall supply. And so stagflation is particularly bad because unlike demand pull inflation, where you're just getting higher levels of prices but lower levels of unemployment, Stagflation actually gets you the worst of both worlds. So you're getting higher prices due to those increases in input costs, but in addition, you're also getting high levels of unemployment coming from producers scaling back production due to those shortages or due to the higher input prices. And so this is basically a worst case scenario for your economy where you have high unemployment and high levels of inflation. This is what keeps economists up at night. They have nightmares. They're like, stagflation, because it's very difficult to solve this problem, as most of the policies you would implement that lower inflation would create additional unemployment, and most of the policies you'd implement to get rid of unemployment would cause higher inflation. So when you find yourself in stagflation, you've got a real problem on your hands. It's very difficult to solve. Thank you very much, and we'll see you in Unit 3.